Welcome back, and we will now continue on the second part of our event. On the CEO Fireside Chats, we have the chance to have a special guest, and I'll first introduce you, Kelley. Hebert, you are, in a few words, based in New York. You're responsible for the coverage of North American insurance companies. You have been more than 6 years at Natixis and have been a banker for the insurance sector more than 30 years. So you have a prestigious guest, as I was saying earlier, and he's connected from California, from LA, and I'll let you the pleasure to introduce him. The floor is yours, Kelley.
Thank you so much, Christina, for that nice introduction. Hello, everyone. I'm really pleased to have the privilege to introduce Jim. Jim is the founder, chairman, CEO, and CIO of Athene. Jim also heads up the Apollo Insurance Solutions Group and has senior roles at Apollo Global Management as a board member, EC member, and partner. Jim Belardi started Athene in 2008 and got seed capital from Apollo. Today, Athene has over $250 billion of assets on its balance sheet and is the key driver behind the growth in Apollo's credit business, which is now over 70% of Apollo's total AUM of approximately $600 billion. Jim is here today to share with us how the retirement services business and focus on credit have led to Athene becoming the #1 originator of new business in its market. It has been a privilege to know Jim for over 30 years. In addition to his many accomplishments, Jim has a terrific sense of humor, is very forthcoming, and I know he will welcome any questions at the end, so please don't be shy. Jim, thank you so much for joining our private debt forum. The floor is yours.
Kelley, thank you for that kind introduction, and I hope we're friends for another 30 years. That would be great. Really pleased to talk to everyone this afternoon about private debt and the modern retirement services model. Why don't you go to the next slide, Kelley? So what exactly is private debt? I think it can be anything you want it to be, frankly. As you can see, the quote from Mark Rowan, it can mean what you want it to be, it can mean nothing, it can be investment grade, it can be non-investment grade, depending on the scope and scale you want to participate in the private credit market. There could be high or low barriers to entry. So not that helpful in really defining it. Why don't you go to the next slide, Kelley? A more conventional, traditional view of private credit comes from our friends at UBS, and you can read what it says there. It's debt financing provided by non-bank lenders, not traded or issued on an open market, usually provided through a private fund or through a BDC, a business development company. And you can see right there the estimate of that traditional view, conventional view of the size of the market is about $1.5 trillion in 4 segments. Why don't we go to the next one, Kelley? Apollo and Athene take a different view than the traditional view. We think the addressable market for private credit is way broader and focused on investment grade. At least that's what we do. For some scaling, you can see the scaling for alternative investments is about 18 trillion, with private credit being a subset of that, about 8% of that 18 trillion, $1.5 trillion. We think a more substantive and better way to look at it is private credit in the scope of fixed income replacement. And that addressable market is multiples of the alternative market size and the traditional view of private credit, somewhere in the vicinity of 40 trillion. and focused on the investment grade segment, which is what we do. Well, we move to the next one. So I think Apollo and Athene have been innovators and offer an integrated asset management and retirement services capabilities. Kelley mentioned over $600 billion of assets under management for Apollo. Apollo has about a $52 billion market cap. Wanted to make sure and update that 49 since I am a shareholder. 4,000 employees worldwide. And then on the right side, Kelley's right. The biggest part of Apollo is Athene. The merger occurred at the end of at the beginning of 22. And Athene, in its size, is about 20 billion of regulatory capital, 250 plus billion of invested assets, highly rated. And the combined firm has many accomplishments and top rankings. #1 alternative credit business, #1 investment grade alternative credit business. Athene is #1 in US annuity sales. And what drives a lot of what we're going to talk about this afternoon is Apollo knows how to invest money very well, in my opinion, as well or better than anyone. And just their private equity track record, you can see in 33 years since they started in 1990, 39% gross returns, 24% net after fees. And the firm has a combined 18% annual CAGR over the last 5 years. So an impressive track record. I'll go to the next one. Excuse me. So we got our first funding from Apollo in 2009 at Athene, and the most noteworthy acquisition we've made was in October of 2013, where we bought the US business of Aviva, the UK company. And that was a $15 billion invested asset Athene buying a $60 billion company, Aviva. We reinsured out the $15 billion of traditional life business that they had because we didn't think we could achieve mid-teens returns in that business. So at the end of the day, after the Aviva transaction, Athene became a $60 billion invested asset company and also brought with it infrastructure and the ability to enter the retail annuity business. When we started Athene back in 2009, the idea was always for this insurance company to eventually be public. Not because we needed the money, because we'd been very successful in raising equity capital in the private markets, but we thought being public would really aid our business because of the transparency and sophistication that comes with being public. But as we were thinking about getting serious about going public, I said to myself, okay, we've done a great job of building the company up to $60 billion through acquisitions, but are we going to command the premium capital markets multiple if we're really just an M&A roll-up shop? And I thought, probably not. So let's add organic growth to our business mix. To be successful in organic, daily flows, retail business, et cetera, you need ratings. And we had none at that time. We built the company to $60 billion with no ratings. But what we did have is the single most important concept in the rating process, which is capital. We had a lot of capital. So we worked at it with the rating agencies, and we got BBB ratings over time, BBB plus, A minus, A. And now we're A plus across the board with positive outlook from AM Best to actually go to a comparable AA rating from the other agencies. And with those improvements in our ratings, you'll see on the next slide, I'll finish on this one for a second. Our organic growth started to really multiply. So we went public in December of 2016. You can see some other noteworthy events on the slide, and then culminated in the January of 22 merger between Athene and Apollo. And every day we're working on educating the investor base about how do those two companies fit, a retirement savings company and a traditionally known as an alt manager. And we think they fit really well. I think investors are getting it. Stock prices have been at all-time highs now for a couple of weeks, but more to come. Why don't we move to the next one, Kelley? So what is Athene? What's their target audience, the target market? You know, before I started Athene with Apollo, I spent close to 20 years at Sun America, which was eventually acquired by AIG. And I bring up Sun America because the Sun America business model is really what Athene was founded on. Not a traditional insurance company. You make more on your assets than you pay on your liabilities, a net investment spread model. But what market do you want to be in? And Sun America, way back 30, 35 years ago, was offering similar products that Athene is offering and targeting the fastest growing segment of the US population, which were baby boomers planning for their retirement. And they were unbelievably unprepared for retirement. Fast forward those 30 to 35 years, and the retirement savings crisis has only gotten worse. You can see the aging of the US population, age 65 and over, gone from 35 million in 2000 people, 55 million in 2020, and estimated to be 80 million, over 80 million people in 2040, with a $4 trillion estimated savings shortfall. And we offer products, various annuities, fixed indexed annuity, that really targets people planning for their retirement, them retire with the right amount of money. Or we move to the next one, Kelley. It's a vast opportunity in retirement services. If you look at everything we've done at Athene, and we've grown quickly, always profitably, the combination of everything we've issued in the retail annuity space and our flow reinsurance is 114 billion out of a market of 3.8 trillion. So it's about 3% of the market. Huge upside to continue to grow there. In pension group annuities, which is solutions for household named companies on their pension liabilities, we've issued $50 billion, but it's less than 2% of the entire pension market in the US and the UK. And funding agreements, a product that we actually started when I was at Sun America. Athene's issued about 21 billion of that. It's a $665 billion market. It's about 3% of the total market. So in every funding area that we operate in, there's huge upside because we've only scratched the surface on penetrating the market. We move to the next one. We believe we're the leading retirement service company, frankly, in the world. You can see the bullets. We provide products that make guaranteed retirement income affordable for Americans. We have a number of competitive edges. We'll talk about that a little later, but scale, we're over 250 billion in invested assets, number one market share in annuities, and 1,900 employees. Next one. I mentioned ratings helping drive our organic growth. Here's where we were. 9 years ago, we did $3 billion, mainly in our retail business. And you can see the steady growth, but the stair-step growth from starting in 2020, 28 billion to 37 billion to 48 billion, and we're going to do over 60 billion this year, and onward from there. We have 4 channels. We're the market leader in each of them. biggest issuer of retail annuities, biggest issuer of pension group annuity solutions over the last 3 years. We had #1 market share in funding agreements in 2021. And flow reinsurance, I think we essentially started that business, and we'll have record inflows in that in 2022. So it's nice to have a multi-channel distribution capability. You can pivot between channels depending on what's most attractive. But we're finding opportunities in all of them as we speak. Next one. So what does it take to be successful in this business? I think by far the key is a successful ability to invest money. Generating alpha, and we'll talk about that a little bit more. That's very, very meaningful. But we don't try to be a hero. We only target 30 to 40 basis points of outperformance versus others in the business. We pride ourselves on transparency, whether it's with our customers, our shareholders, rating agencies, our regulators. Our approach is they're all partners of ours. The more they know about us, the better. So no company is as transparent and forthcoming with discussions about our business. We have postings on our website on every single subject, from commercial real estate to our organizational structure to where our capital is to our asset quality, I mean, et cetera, et cetera. And I think it's really helped us and built confidence in our investor base. And we're very disciplined on the type of liabilities that we bring on our books. We like as simple a liability as you can get, long dated, confident, protected by surrender charge and withdrawal restrictions. So there's no surprises and outflows, and we can invest with certainty behind these liabilities. Why don't we go to the next one, Kelley? A little bit about our asset portfolio. It's very high quality. 94% of everything we have is in fixed income or cash, and 96% of that is investment grade. We essentially have about 5.5% at non-investment grade. We have 6% in our alternatives portfolio of invested assets, and it's not a traditional alternatives portfolio. Very few hedge funds and traditional private equity. It's a lot of fixed income type cash flowing, non-directional bet assets there. And it's been a very predictable performer since inception for 14 years. It's been about 11% return. We target double-digit returns with lower volatility than the public equity markets, and we've achieved that. When we go to the next one. Every day we spend a lot of time on relative value. Try to keep it simple. Lean in when things are cheap, back off when things are expensive. Target higher and sustainable risk-adjusted returns, not by taking more credit risk, but by capturing an illiquidity premium that really is the driver of our outperformance. We have two key tenets in our investment philosophy. One, downside protection. Don't lose money. And two, outperform on total return on asset yield. And over the 14 years, we've been able to do both. We pay attention to detail. We try to empower the people we have to make decisions. And we try to set at the top level here the strategic direction and what makes the most sense. Proprietary asset origination is really an important component of our philosophy. I'll move to the next one. Yeah, as this slide says, sourcing a recurrent supply of attractive assets is critical. You can see how Apollo's debt origination volumes have increased just since 2020. 2020 is 50 billion, 86 billion. We through 6 months in the previous year and this year, and expect to triple the 2020 volume in the next few years. Always targeting 100 to 200 basis points of outperformance in private assets compared to same rated public assets, corporates. Oh, excuse me a second. And I lost the video here. Hold on a second. Sorry about that. And we'll talk a little bit more about, we have 16 platforms that Apollo has originated, which provide typically a back book that Athene can buy, an ongoing flow from these origination platforms that make sense for us as well, all investment grade in different sectors. It's diversified. We can talk a little bit about each one of them if we'd like at some point, but it's a real difference maker. And I don't know of another company in the world that has invested as much time, money, and people in originating high-grade alpha fixed income assets as Apollo has. And Athene has been a key beneficiary of that. Why don't we go to the next one? Yeah, it's key to manufacturing asset spread, which is the key driver of the company's performance. This slide shows in the investment grade universe, the current on the margin spreads. So 150 basis points over treasuries for public investment grade corporates. Average rating an NAIC 2 in the triple B category. Just on the next part of the slide, it shows 4 platforms, starting with Atlas and how much outperformance on yield they have with similar ratings to public IGs on the left. And you can see Atlas's spreads are 325 to 425, et cetera, significantly more than the public IGs. When you add 10 times, 11 times leverage, that's very meaningful ROE production and outperformance. So on an ongoing basis, Apollo direct origination platforms systematically originate IG assets at 100 to 200 basis points higher spreads than the broadly syndicated markets originate. We move to the next one. So where is Athene's portfolio differentiated versus others in the insurance industry? It's principally in 2 areas, structured securities and private corporates. You can see the percentages of invested assets in each of these. Our participation in buying of structured securities really started at our founding. When we started Athene with a reinsurance transaction, and we needed to invest the money that came in, and we had 3 people in Los Angeles and 4 people in Bermuda, and we didn't have any scale. So I went around and interviewed household name asset managers, the Goldmans and Morgan Stanleys and PIMCOs and Guggenheims of the world, and listened and decided what mandates we were going to give to each. So one firm said, I told them we want to do some CLOs, one we want to do corporates, one we want to do asset backs, et cetera. We never gave up the credit pen. We always made the final decision. And, we were a peanut in size then, and it was hard to get attention from these big guys. But some of us were pretty good at yelling and getting their attention. And so the idea was, we'd start with this, but then if we got some size and scale, we'd get rid of the third-party managers, hire our own people who are dedicated 100% of the time to investing our money, and have actually better performance. And that's exactly what happened. As we grew, we hired our own people. And now we think our cadre of people that we have investing money in our investment portfolio is second to none. So it's been great. But I bring that up because at the beginning, when I looked around the fixed income landscape right after the financial crisis, the Lehman crisis of 2008, And I looked at how many times within structured securities, defaults and severities could go up before we lose a cent of principal. It was almost a no-brainer to really emphasize RMBS, CMBS, and asset backs and CLOs over the traditional asset allocation view that most insurance companies take of mainly public corporates and maybe some commercial mortgage loans. That paid out very well. And even today, though, even though everything's more expensive than it was right after that financial crisis, we're still finding value in these structured securities. Why don't we turn to the next page? And why is a structured credit an attractive asset class? A, because you get paid for structural and illiquidity premiums. And if you really look at it, and we have a slide on this, structured securities in general have been safer, less defaults, less severities than public corporate bonds. So if you understand what you're doing, the subordination and diversification of collateral, et cetera, and pools, this can be a really important value add asset category. And we found that to be the case for the entire 14 years of Athene. There's diversification, there's credit enhancement, and structural protections that really give rise to lower defaults versus corporates. When we turn to the next. And the facts speak out. BlackRock ran aggregate assets of U.S. life insurers from stat filings. And the conclusion was investment grade corporates had a higher expected loss than structured credit. And that's been the case in actuality as well. One of the other things we've posted on our website is papers from professors concluding the same thing based on the facts. And I mean, you can see each asset category here. High yield and bank loans, 14.7% loss percentage. IT corporates, 7%. CMBS, well, you can see them down there. So ABS and CLOs, almost nothing. I'm not sure everybody realizes that, but I'm glad we have the data to support it. Want to go to the next page, Kelley? So that was one of our two kind of outlying allocations in structured credit. And then we also have it in private corporate debt. Look, the bank's share of overall lending has been on the decline, which has prompted private investors to fill the void by lending directly to borrowers. And Apollo has really stepped in on that in a good way in the investment grade segment of the market. And you can see on the right, that little chart, non-financial corporations are twice the business that banks do now, which is a pretty important statistic. We turn to the next page. Here we have three examples of high-grade alpha, as we call it, private debt transactions that Apollo originated and structured, and Athene took significant portions of each of these deals. Say SoftBank was a fund financing. It unlocked liquidity for the GP. I mean, I think an overriding statement on these private credit transactions are we can tailor specific, bespoke solutions to solve whatever problem each of these borrowers wants to solve. It's different for each of them, but we've been successful in doing it. Once we can get into a one-on-one conversation with these companies, we can get to the right answer for them, and that's been the history. So that was a big deal. That was an upsized deal to $5.1 billion for SoftBank. Attractive compensation, investment grade ratings, and Athene and Athora, our continental Europe M&A entity within the Apollo family that Athene is the biggest LP on. We took a third of the entire financing of SoftBank. RGA, there was a surplus note transaction, monetized a portion of the future profits from a closed block of insurance business via an investment grade A- rated security with attractive relative yield. In that case, Athene spoke for approximately a third of the transaction by itself. And then the final one we have here is a clean energy transaction, senior secured notes. Apollo managed funds purchased approximately $200 million of this, investment grade again, to finance a renewable energy investment. There's plenty more examples. We thought we mentioned a few, but it's always bespoke, tailored to the individual needs of the company. Let me go to the next one. So the key takeaways on this presentation, I think, are: one, the traditional view of private credit is too narrow. True meaning is, fixed income replacement, and is multiples of what the size estimates of the traditional view are, headed by the fact it's investment grade, and that's really only where Athene and Apollo transact, at least Athene does. Fixed income replacement presents a massive opportunity for growth of private credit markets. We've only scratched the surface of that market. 3, building direct origination capabilities is critical and paramount to sourcing private credit. And 4, private credit can help generate alpha within investment portfolios, which is the most important metric for the net investment spread business that Athene is running. So we're very proud of what we built. Really a pleasure for me to speak with you guys, and I look forward to some of Kelley's questions and hopefully some questions from the audience. Thank you very much.
Thank you, Jim. That was super informative and a very impressive execution on Athene's strategy that you described. So let's chat a little bit about the private debt market and how Athene and Apollo approach it, and then we'll open it up as well to questions from the audience. The private debt market has been growing. There is a lot of dry powder for this asset class. In fact, Apollo announced only yesterday that it raised a $2.5 billion fund for doing large corporate direct lending. So the question is the market getting crowded from your perspective, or are there enough forces that will create plenty of further opportunities for investors?
Well, look, my few opening slides in the presentation talk about our definition of the market, which is way larger than the traditional view. So, and larger than many people think. So we think there's a much bigger opportunity with predominantly investment grade equivalent private credit used as fixed income replacement. I mean, it's huge. It's about a $150 trillion market. The broadest definition would yield that. If you then exclude government securities, agency mortgages, et cetera, it's huge. 40 trillion for investment grade fixed income. And we see a vast opportunity set within that market, particularly in areas like trade finance, equipment finance, leasing, commercial finance, and consumer finance, all structured to be investment grade. So no, we're not worried about the size of the market. We just want to capture more of it.
Got it. Yeah, that leads very well into kind of the next question, which is you talked about the direct origination, the 16 platforms for directly originating assets and the value that they bring. And from an insurer's perspective, if you could talk a little bit about whether you're able to achieve the diversification that you need from these sources of private debt.
Yeah, I mean, these 16 origination platforms generate assets across various sectors, including commercial finance, real estate, transportation finance, fleet leasing, and consumer, which provide diverse investment opportunities for Athene's portfolio and third-party clients. They're diversified across sectors of the economy, by asset class and structure, in terms of the assets they're generating. For example, MidCap is a lender that serves as a key source of capital for the middle market. Companies in general in the US. They provide a range of asset-based solutions, typically packaged into CLOs that get investment grade ratings, which Athene has invested in. Another example is Wheels, which is a fleet leasing business that helps minimize the total cost of vehicle fleet ownership for blue chip corporate clients. And in the form of asset-backed securities, which Athene's also invested in. And diversification also extends beyond platforms into high-grade alpha financings. And it kind of leads to a mantra. I'll give you a little bit of background here. In early days, when Athene was growing quite a bit, Apollo's origination machine wasn't as mature and efficient as it is today. And so to satisfy Athene, we were taking most everything Apollo could generate. But Apollo, to their credit, has built their origination machine significantly. And now, over the last year and a half to 2 years, for the first time in Athene's 14-year history, Apollo's origination machine, even though Athene's growing incredibly fast, is sourcing more than Athene wants. And so the way that the program works is an asset comes that's originated, Athene signs up for how much it wants, and Apollo goes out to third-party clients, other insurance companies, et cetera, and sells it to them. The fact that Athene's in for big size validates it, and I think a lot of companies try to emulate what we're doing on the asset side, so that's a good start. But it leads to the conclusion, no longer does Athene have to sign up for most everything. We now have a mantra that is 25% of everything Apollo originates and 100% of nothing, which is a Mark Rowan phrase, so I don't want to take credit for that one, but I think it's accurate.
Yeah, well, thanks for that. I mean, I think that you kind of addressed another question, which was within the private debt landscape, from sort of low middle market all the way through large corporate, you know, which sectors are you focused on? It sounds like it's across the entire spectrum. Is that correct?
You're right, Kelley. I think we can provide solutions for both the lower middle market and jumbo borrowers. Several of Apollo's origination platforms generally serve smaller borrowers or businesses like MidCap, HADOC, foundation home loans. But at the larger end of the spectrum, you know, we have I think Apollo has a strong track record of sourcing high-grade alpha transactions, which are big, investment-grade transactions, typically a little more complex with some of the largest companies in the world, like AB InBev, SoftBank, AT&T, Air France, and others. And Athene has taken a large stake in each one of those. And the fact that we have that big pool and capability of taking large sizes of these deals helps make sure that these deals get done and find a home. And Athene's role is an integral component of Apollo's HGA capabilities. So it really is working well between Athene and Apollo.
Right. So you, leveraging off what you've said here, you also referenced that the model is being emulated. And obviously we've seen that that is the combination of alternative asset managers and sponsor firms aligning with insurers and bringing together asset management expertise in private debt and alternatives. And just interested in your thoughts about what you feel the competitive advantages are for Apollo and Athene vis-a-vis the other firms out there that are pursuing the same model.
Yeah, sure. Some people say they're flattered by imitation, but I'd rather not be flattered and not have the competition, but that's not going to happen. So, but no, these are good firms and good competitors, but we do have a number of significant advantages, at least 5 I'll mention just quickly. We think we invest money better than anyone else, which is the number one advantage. We have long-term, predictable, protected by surrender charge liabilities. Also, in most cases, cheaper than others because we're the biggest issuer of annuities, and we do very little fully guaranteed rider business, which is the most expensive part of the fixed indexed annuity business. We have less than that than most everybody else. So liabilities are an advantage for us. Scale and efficiency. Our Des Moines-based operational center in Iowa is very efficient, very low cost. We're at scale, meaning we can add tens of billions of dollars of business with almost no incremental cost. And that's aided by the fact that we have no legacy issues. Most insurance companies have some kind of legacy issue, businesses they don't want to be in, which costs money. And fortunately for us, partly because of when we started, every business we're in, we want to be in. Fourth, maybe it should be higher on the list, capital. By design, from day one, we've always run with excess capital, allows us to be, and liquidity, allows us to be opportunistic and lean in when things are cheap. I'd also add ratings is one of the biggest barriers to entry in this space. And I talked a little bit about how because of capital, we've really improved our ratings up to the A+ across the board. That takes a while. And will we get to AA-? Perhaps. We'll see, but that's a competitive edge for us as well. And along with that is this first mover advantage. We were early on, we built this business, we have scale now, and for a lot of our markets, as we talked about, we're the go-to company, so that's hard to emulate quickly.
Thank you. Very clear. So I think we will open it up here. We have a few minutes for audience questions, and Christina?
Questions, please. Don't hesitate to raise your hands. Yes, we do have a couple of questions over there. I think we have another question, so we'll get ready for the second one. Can you raise again the... Yes? Great.
Hello, I'm Greg. I'm part of Natixis in Asia. I'm very impressed to hear this presentation. We are obviously very connected with the group as institutions in Asia, but also globally. One of the questions I have in mind when I hear you is, what is the value forward-looking, right, in the replacement model you basically are showing here, the universal model as an investor? What is the value to you of banks? How do you see banks as partners or potential competitors or help in your growth, actually? Thank you.
Yeah, sure. Thank you for that question. Thank you for the kind words. Private capital is taking market share from banks, but we're partnering with banks on a regular basis. So banks typically want to own the customer. We want to own the asset. But more and more, we're partnering with banks, and the pie is so big, there's space for both of us. So this is not an either-or situation. I mean, one of our platforms, Alliance, is partnered with BNP Paribas. The Atlas structured credit portfolio we got from Credit Suisse, did a large transaction with PacWest, the regional bank. So there's going to be more of that to come. But no, we, as opposed to just competitors, we view banks also as partners.
Our second question? We'll take only one more, sorry, but I think there's a microphone over there. Yes, please. If you can stand up, please, that'd be great. If
sure.
we can catch her. Thank
Jim,
you.
hi, it's Mark Woolley, also from Natixis. Apologies, 2 Natixis questions. If I may, 2 questions, if I may be so cheeky. The first one, first of all, we see the huge growth rate in your annuity side business. As you say, the asset side business is growing even faster if you look at the whole of Apollo. But
Could you please bring near?
okay. Sorry, that's better. When we talk about essentially the substitution of the public bond markets and the bank credit markets, admittedly at the margin, not completely. And when I put that together with, especially when thinking about large corporates, some murmurings from, for example, rating agencies, that there's an element they're looking at of capital structure arbitrage, where some private credit loan deals, and you mentioned AB InBev as one of those, that potentially subordinate existing bondholders, bank lenders, etc. Is that an inherent factor, or is that an incidental factor in terms of how to originate excess yield on investment-grade assets from that sector? And if I may, the second question is hopefully a slam dunk. You also, in one of your earlier charts, talked about the PRT business, and you mentioned the UK, a business which Athene has been thinking about and looking at, the UK annuity business for years, as far as I'm aware, but not yet entered. Obviously, just yesterday, we had a new entrant in that market from one of our other speakers this morning, M&G. Is that a market you see yourself entering in the future?
Yeah, good question. Thank you. I'll go in order. I think the answer to the first one, I think that's incidental, not systematically always there. Look, we got a number of experts at Apollo in structuring these private credit transactions, thickness of tranches, attachment points, et cetera. And we have some in-house experts on how the rating agencies look at these things. So we decide how much we want of which rating category and structure accordingly. And very few times are we surprised what the actual outcome is on the rating. So I think we know how to structure for the optimal outcome and placement in the hands of both Athene and third-party insurers. And on the PRT question in the UK, we've done one deal in the UK. We actually are looking for a partner. We think that's the best way to attack the market. But it's a huge market. It's actually, I think, a bigger market right now than the US market is. So it's a market we want to be in, and it's just taking some time to get to the right partner combination and structure to be in the market. So, but both good questions, and we love questions from Natixis.
Well, thank you very much. I think you have the final word.
Thanks, everybody. And Jim, thank you so much for participating and sharing your thoughts with us at our forum today.
Really enjoyed it. Thank you, guys.
Great applause. Thank you. Thank you, Kelley. Also, thank you both. Thank you very much.